There's an opportunity cost to a company like Meta. They're investing heavily into an advertising downturn. And on top of that, we have Apple privacy issues, TikTok competition. These challenges aren't going to go away quickly. And I question, what is the return on investment that an investor can get when they're investing $12 billion in the metaverse? And we don't know what we're getting for that. I would rather own something like ServiceNow, a more resilient software business, 99% renewal rate, Department of Health win recently, low M&A risk, all of that. And also vendor consolidation could benefit a company like that. So in tech, there are going to be winners, but I think Meta is going to be challenged going forward.
Well, how timely you suggest ServiceNow, a stock that's up 10% in overtime on its own results, which is, interesting, just given questions about the cloud and enterprise spending and everything that goes along with that. How do you feel in general about technology as a group, given what you've heard so far, and, carefully ahead of Apple and Amazon tomorrow?
Technology is going to be challenged in a long duration environment when interest rates are going up. So that's going to be the issue. If you look at mega cap stocks, until recently, most of them, except for Meta, had been outperforming the NASDAQ. So they're not exactly cheap. Apple versus Amazon, challenging, but I'll take Amazon over Apple. Amazon has already been investing heavily. I think over the long term, we will get returns from their logistical investments. Apple is still going through that normalization period post-COVID where they had superior volume growth, and that's going to have to normalize to the low to mid single digit level. That could be painful for investors as we go through that. But all of these mega cap stocks, especially the ones that have an advertising business, are going to be challenged as there's a cyclical downturn, especially if they continue to keep investing heavily in their businesses.
You heartened by the fact that earnings appear to be better than at least was feared, or are you not sold on that narrative, which has certainly been put forth since the beginning of this most recent earnings season?
So this earnings season, we're seeing overall beats of about 4 to 5%, and that's good news, but we saw pretty significant estimate cuts coming into earnings. My concern, though, is 2023 earnings. Consensus still is looking for 7% earnings growth. I think that's going to be very difficult to achieve. It's unrealistic when we're going to be experiencing the repercussions of significant rate hikes and likely a recession. So that number coming down, I think, is why the S&P 500 valuations are likely too high where they are.
Yeah, all that said, I've kind of described this as a now and later market. You've got, the now, maybe the economy is strong enough now and earnings are good enough now versus what is inevitably going to take place later. Does the now give you at least a little bit more steam in a rally between now and the end of the year or not?
I think it does give us some steam, and also we may get some euphoria when the Fed starts to moderate rate hikes. I don't think we'll see that next week. I'm expecting 75 basis points. If they go down to 25 basis point rate hikes in December, markets could be positive on that. I think what we're missing, though, is there could be a long tail of moderate rate hikes going forward. The Fed's been pretty clear. They want inflation to get down to their target. CPI is still near all-time highs. I think inflation is pretty sticky. Good news is I am seeing some real-time data of inflation moderating, but I don't think that really flows through to a 2% or even 3% CPI number for a long time. So the market dealing with continued rate hikes in 2023 could be the story that keeps a lid on the S&P 500.
All right, we'll leave it there. Sarah, appreciate the time, as always. That's Sarah Malik.
Thanks for having me.
Of Nuveen joining us in overtime. We'll see you again soon.